Good morning. I want to thank everybody for logging in and calling in today for our webinar, special Friday morning edition. We're going to talk a little bit about the differences between a solo 401k and self-directed IRAs. Kind of the differences really that the two have. There's a lot of common, a lot of similarities, but there's a few key differences I want to just highlight for our clients and people that are listening. We deal a lot at Advanta with talking about self-directed IRAs, but we can also service solo 401k plans as well. So I really hope that today's webinar will illustrate some of those key differences and make sure that the account, if you're looking for a new account for yourself, that you really understand the differences between these two types of accounts. My name is Scott Maurer. I'm the Director of Business Development for Advanta IRA. Also a licensed attorney. I don't do any legal work for Advanta clients, but that is my educational background. And I have been with the company for over 10 years, and during that 10-year time, spending a lot of time with individuals, not only getting the accounts set up and choosing the right account for them, but also helping them through different investments as well. And I spend a lot of my time now really trying to educate and teach people about self-direction, whether it's buying real estate, whether it's buying into a private note, or whether in this case, today we're going to talk about differences between the different accounts you can have at Advanta that can certainly be self-directed as well. Now, one quick disclaimer, at Advanta, we do not provide investment advice or endorse any products. One thing we do as a self-directed IRA, we simply administer accounts and taking direction from the client as to what they want to invest in. We do not sell anything. We simply provide that service that if you're looking to self-direct your IRA, self-direct your 401k, and buy alternative investments, we do the administration, we do the record keeping for those assets. And in that same vein, we don't give legal, tax, or investment advice. Now, in the courses of a lot of our seminars and our webinars that we do discuss some legal issues. We do discuss some tax issues, which we're fine doing. But as far as making a determination for a client, whether an investment or a strategy should be done from a legal or tax perspective, that is up to the client to work with their own attorney, CPA, accountant, tax preparer, to get that type of advice. So we can certainly refer to people, though, in those fields if there are people who are looking for some more information about self-directed IRAs. Just a quick background on your company if you're new to Advanta and new to our webinar format. Again, thank you for coming, and if you have questions, anyone has questions, say during the webinar, please type those into the chat box on your screen. I'll make sure that I get to those. We're also recording this webinar for other people who couldn't make it live, and if you're someone who's listening to the recording, my contact information will be at the end of the webinar to reach back out to me. But again, for those of you who are new to Advanta, again, thank you for joining us. A little bit about our company. We've been around since 2004 as a self-directed retirement account administrator. Again, we don't sell any products. We simply are in the business of doing investment administration, record keeping for qualified money. And qualified funds are any type of employer-sponsored plan, whether it's a 401k, 403b plan that someone's rolling over, and certainly any IRAs. So we only handle those types of retirement dollars. We can't handle personal savings or checking accounts and doing administration for those individuals. I think our strength is in our service. We have a local feel for all clients, regardless of where you're located, in a concierge and an account manager system where everyone who signs up and becomes an account holder at Advanta gets a personal representative to help them with all aspects of their account. Now, before we get into the 401ks and IRAs, just kind of covering some just the benefits or basics really of self-direction, and really why people choose to look for alternative investments that we're going to talk about today within a retirement vehicle. And taking a recent client survey poll that we sent out and just talking to people in general who call and are interested about self-direction, a lot of these reasons are present for many individuals. For some, they're looking to self-direct simply to get more diversity within their retirement account. The proverbial not having all your eggs in one basket applies, and people wanting to just have their money in a couple different places to really protect themselves and hedge against any world events and things that might happen. But I think really that the main reasons that people look to self-direct is really choosing something that they understand. Instead of investing in a mutual fund or investing in a stock where you're yes, you can see the money, you can see the little graphs go up and down and maybe understand a little bit why that's happening, but not always comfortable in choosing that stock or choosing that mutual fund, and certainly not being happy about it when nothing you've done causes your stock portfolio or mutual fund portfolio to go down. So people are looking to invest in something more tangible, something maybe they can get a better rate of return on, and something ultimately that they have more control over and feel safer with. And that's why a lot of people look for self-directed assets and things that we'll talk about today. Again, we'll talk a little bit about that. Most of the presentation today is on the 401k versus the IRA. But when it comes to the investments you can hold in a self-directed account, any type of real estate, as long as it's for investment purposes, it can't be property that you want to live in or use. It can't be property that you already own that you were going to buy with your IRA or your 401k. There are some restrictions there. But other than that, if you're looking at holding rental property, rehab projects, residential, commercial, it doesn't matter. If it has a deed, your IRA can certainly invest into it. We also see a fair number of other paper assets. These are assets that the previous screen was individuals investing in real estate, brick mortar, dirt, something you can actually see, something that you can touch. But a lot of individuals find investments in self-direction into other assets that are more of on a piece of paper. Someone signing a promissory note or signing a mortgage loan document. That is an asset. That is an investment. I mean, banks hold millions of mortgage loan documents as assets on their books. Your IRA can simply be that lender in that position of a bank and holding that note and mortgage loan. When you see on this screen, obviously tax liens, unsecured notes, debentures, options, assignments, a lot of different things you can do in a paper format. The IRS actually says the only two things you cannot invest in with your IRA are life insurance and collectibles. So stocks, bonds, real estate, mortgage loans, assignments, limited liability companies, farm animals, movie projects, commodities, foreign currency trading. The list really just goes on and on. As long as you're not getting into life insurance or collectibles, your IRA can potentially, or maybe in this case a solo 401k, can make that investment. So again, we see a lot of different alternatives that Advanta, the example we're going to go through today to illustrate the 401k versus an IRA, we'll center on real estate. Predominantly, the assets we see at Advanta are real estate based and real estate related, but again, there's quite a number of other different assets that you can invest in as well. So what are the vehicles? What types of accounts can you use? What types of monies can you use to actually make a self-directed investment? We'll go through the list here and then get a little more detail in just a moment with some of the accounts. But any type of IRA, whether you have a traditional IRA account, whether you have a Roth IRA account, whether you are self-employed and you have a SEP or a simple IRA, or maybe you work for a small business that offers a SEP or a simple IRA, any type of IRA can be self-directed. It's a matter of simply transferring money from your current custodian over into a self-directed IRA and making that investment. One account that we are going to focus on more so today as well is a qualified individual 401k or individual profit sharing plan, where you as a sole proprietor, someone who may own their own business, you don't have any employees, can set up a solo 401k plan just for yourself. You don't have to go through the red tape of a major, or I would say a larger 401k when you have employees. Very streamlined, safe harbor individual 401k plan. It's very simple, very easy to use, and then has some benefits as opposed to simply using an IRA account. Again, these qualified individual 401ks are for people who own their own businesses or who are sole proprietors, and we'll again go through the benefits here in just a few moments. You can also self-direct any former employer's plan. So if you have an old 401k from a previous life, a 403b, a 457, maybe a thrift savings plan, if you work for the government, once you leave the employment of those companies or those institutions, you can roll those monies out and in turn self-direct. We also offer education and health savings accounts. So those are not retirement accounts. That's one difference here between those and the accounts, the IRAs and the 401ks we're talking about. But they can also be self-directed. We're not going to talk about those accounts much more today, but keep in mind an HSA or an ESA can also be self-directed. Now the main difference between a lot of the different types of IRAs, in this case we're going to talk about a 401k as well, is basically the amount you can put in out of your pocket on an annual basis. It's one of the huge differences, again, between these accounts. Now, the Roth IRA has another big difference we'll discuss in a moment, but when you're looking at a traditional IRA or a SEP or a simple IRA and even the 401ks, they are all tax-deferred entities. Again, the Roth is a little separate, but those other accounts are tax-deferred. They're going to grow as you make and reinvest throughout the time you have those accounts. You don't pay taxes. It's only when you pull the money out in retirement that you pay taxes on that money. So they're very similar in a lot of different functions, but one of the main differences with all these accounts is how much you can contribute out of your pocket in a given year. Now, the IRS places no limits on how much you can earn in your IRA. They place no limits on how often you can move money between accounts. They place limitations simply on how much you can take out of your pocket each year and contribute into those IRAs. And you can see for a traditional or Roth IRA, you're limited to $5,500 or $6,500 a year. With a SEP IRA, you can put in up to $53,000 into a SEP. You can put up to 25% of your compensation into a SEP. And again, the SEP, the simple, and the 401k, these accounts are perfect for individuals who own their own businesses. Again, whether you're sole proprietor or have a couple of employees, these can really allow you to sock away a lot more money each year. So a SEP, you can put up to $53,000. With a simple, you can do a salary deferral of $12,500 and do a little bit of an employer match on top of that. And that's very similar to the 401k. Now, 401k, you can defer the first $18,000 of your salary, and you can see there if you're over 50, you can actually contribute up to $24,000 of your salary into the 401k. And then your employer can elect, if they choose, to match up to 25% of your compensation to where the total combined salary deferral and employer match is that $53,000 number, or again, 59 if you're over 50. Now, when you have a 401k, and in this case a solo 401k, if you're your own business, you as the employee taking salary can defer your salary into the plan. And then you are also the employer. You can match up to 25%, really maximize how much money you're getting in to those plans. We'll go through this in just a moment, really an analysis of the different types of accounts. And you can see the numbers there for the ESA and HSA as well. So how much could I contribute? So we're going to take a hypothetical individual, someone under age of 50, has $100,000 of earnings, basically compensation that is subject to Social Security and FICA taxes. Here is what they would be able to contribute to the different types of accounts. So this is kind of, this is really, again, an example where we can talk maybe a little bit about contribution limits. How much you can actually contribute would be best answered by your CPA, by your tax advisor, who can look at your numbers and make sure that this is correct. But in general, to contribute to an IRA, it does have to be earned income. So again, a compensation subject to Social Security, FICA, self-employment taxes. So for someone with $100,000 of qualifying income with a traditional or Roth IRA, they're limited to putting in only $5,500 a year. Again, because those accounts, that's just a flat limit, and it's, again, very restrictive on exactly what you could put in. If they are self-employed, and again, qualify with a SEP IRA, they could put up to 25% of their income into a SEP. So they could put anywhere from $0 to $25,000 away into a SEP. For a simple, they could defer the first $12,500 of their salary, and with a simple IRA, you're allowed to do upwards at a maximum of a 3% match. So the $12,500 of the salary, 3% on their 100 is another additional $3,000. So a total with a simple of $15,500. And with an individual 401k, actually there's a little typo there, it should be $43,000 is actually the total contribution. Because with the individual K, you can defer the first $18,000 of that 100 as salary deferral. And on top of that, the company can do a up to 25% match. So you basically have the SEP IRA acting as the profit-sharing contribution and also being able to defer your salary. So the reason why the 401k can be very popular is the ability to put more money into the account with less amount of income. For a SEP IRA to max out at $53,000 based on the formula, you need to have over $200,000 of qualifying income. But with a solo 401k, you can get there with much less actual qualifying income. Now, one key thing we start talking about traditionals and Roths and the difference between those types of contributions, just keep in mind with an individual 401k, that $18,000 of salary deferral can actually be made as a Roth contribution. I'm sure many of you on the call realize how powerful the Roth is. We'll go over it anyway in just a moment. But that $18,000, you're looking over 3 times as much dollars you can put in a Roth 401k each year than a Roth IRA, and have that money growing tax-free is, again, very, very powerful. So just quickly looking at some of these accounts in just a little bit more detail. The traditional IRA, Probably the most common type of IRA that's out there, an account that is tax deferred. When you make contributions, you put your $5,500 a year into a traditional IRA, you'll get a tax deduction for making that contribution. The account is then going to grow tax deferred, so as you invest and reinvest through your IRA and into real estate and notes and other types of investments, you won't pay taxes on the gains as you go along. So the ability to compound your money, when you don't pay taxes, you can compound your money much more quickly, grow that account much more, so when you get to retirement, you're pulling from a much bigger bag from your nest egg. The reason why the traditional IRA, I think, is there's so many traditional IRAs is that any old employer's plan, a 401k, a pension, again, the 403bs, the 457 plans, when you leave an employer, you can roll the money from those plans directly into a traditional IRA with no tax consequence. So if you had a 401k through your employer, you may have an option to invest in a pool of 20 to 25 mutual funds, perhaps, and that's kind of all you have as an option while you are in the 401k. But once you leave that employment, you could take that 401k and put it into an IRA. You could put the money in a CD at a bank. You could buy stocks at E-Trade. You could buy investment property, buy private notes, private LLCs. You have so many more options. So a lot of people, when they leave an employer, choose to pull that money out and get it into a traditional IRA. So again, that's why you'll see more traditional IRAs than you will really any other type of an account. And traditional IRAs have also been around so much longer, since 1975. Roth IRA, very quickly, works very much the inverse of the traditional IRA. Now, Roth IRAs came into being in 1998, so I wouldn't say they've been around now for a little while, but not as long nearly as the traditional IRA. With a Roth IRA, the benefits that the Roth gives you are really huge when it comes to the earnings that you're making within those accounts. Now, as opposed to a traditional IRA, when you make a contribution to a Roth, so you put $5,500 into a Roth IRA in 2016, you do not get a tax deduction. Okay, so a traditional IRA, you get a nice tax deduction, helps you when you're filing your income taxes. You put that money into a Roth, you're not going to get that help now. And that's the one trade-off, that's the one downside of investing through Roth, is simply not getting that initial deduction. But what your Roth is so powerful is that since you already paid tax on the seed and the money that you contributed in, you can grow that account on a tax-free basis going forward. So as you invest and reinvest again into stocks, mutual funds, real estate, notes, LLCs, you don't pay taxes on any of those gains, just like a traditional IRA. But the difference is when you get to retirement age, with a traditional IRA, when you pull money out of retirement, you at that point then have to pay some taxes. Still not a bad deal to have a traditional IRA growing tax deferred and having to pay a little bit of tax at the end. But with the Roth IRA, what is so powerful is that money is going to grow tax-free. So as you invest and reinvest, you don't pay taxes. And when you reach retirement age and you pull money out of your Roth, there's absolutely no tax due on what you pull out. And again, you can say it numerous times and tell people, some people still don't always grasp it, but a Roth IRA is a tax-free investment vehicle. So the profits you make on your investments are eventually going to come back out to you without ever paying taxes on them again. That's why Roths are so powerful. While people guard that money very closely or like to take advantage of good opportunities inside a Roth, knowing that what they earn is going to ultimately be tax-free. Now, the one thing that the Roth IRA has, and this will be contrasted with the 401k we talked about in just a moment, is a Roth IRA, the IRS does limit your ability to contribute to a Roth IRA. So that $5,500 a year, not everyone can contribute that to a Roth IRA. The IRS phases out the ability to contribute dependent on your adjusted gross income. And you can see on this chart and on this slide, for a single individual who makes over $132,000 of adjusted gross income in 2016, you cannot contribute to a Roth IRA account. So regardless of your ability, your desire, the IRS simply will not allow you to make that contribution. You can see the numbers are a little bit different for people married filing jointly. So again, keep this in mind when we start talking about the 401k in a moment. The Roth IRA has this particular limitation. Now, there are some workarounds of putting money into a traditional IRA and then doing what's called a conversion to the Roth that may allow you to still get some money into a Roth even regardless of your income. But just in general, you cannot contribute directly to the Roth. So just keep that in mind. Now, the employer-based accounts, the SEPs, the Simples, and the 401ks, again, these are great for sole proprietors. people who are independent contractors, or people who own their own business. The SEPs and the simples, if you do have companies, if you own your company, you do have employees, the benefit that the SEP and the simple give you over a 401k is administrative costs. With a SEP and a simple, you simply make sure you're following the rules, making contributions for your employees, and you don't have as much administrative oversight from the IRS. But if you have a 401k plan, you have a company with multiple employees, the IRS requires you with that type of plan to have certain types of discrimination testing done on a yearly basis, where the third-party administrator has to come in, make sure people are being treated fairly, making sure the plan isn't only benefiting highly compensated employees. So there's more administrative costs in having a 401k plan for a business with employees as opposed to having a SEP or a simple IRA. There are certain employees you can't exclude, we'll talk about in a moment, but there's also certain employees that you have to include. So a SEP and a simple, that's the reason sometimes why people do choose to do a 401k, because you have to kind of force people to opt in to the 401k and make contributions. So again, the one thing that the 401k though has that sets itself apart from the SEP and the simple, and again going back to the last slide and talking about the Roth, is that with a 401k, and in this case what we offered Advanta, an individual 401k, you have the ability to make Roth contributions of that $18,000 of salary deferral we talked about a few minutes ago. So you do not have that option within a SEP. You do not have that option within a simple. So if we're talking about someone who is self-employed, you don't have any employees to worry about making contributions for them, a solo 401k really would allow you to put much more money into a Roth type plan each year. And as we showed a few minutes ago, you can just simply contribute more in general to those accounts. Now, which of these accounts is best for you? That's a question for your tax advisor. They know your tax return. They know how your business is set up to decide really which of these accounts is really going to benefit you and what you're looking to accomplish. So again, the people who would benefit, people who own their own businesses, you can include your spouse as well in these types of plans. And also, again, businesses, if you may have employees, but they may be excluded. You can exclude under a SEP, a simple, and a 401k anyone who is under the age of 21. So if you had a business, maybe you had just a couple part-time employees, but they were under the age of 21 doing some filing work or just doing a few other things for you, they don't have to be included. If you have looking for a solo 401k plan, as long as none of your employees work more than 1,000 hours a year, you could still have a solo K plan without having to do that administrative testing I talked about, where it can get more expensive to run that type of plan. The individual K plan is very streamlined, easy. There's not the reporting involved with a solo 401k that there is with a more traditional 401k for a company with many employees. But if you do have individuals who work more than 1,000 hours a year, they would have to be included, and therefore raising your cost at that point. But if you have somebody you employ for just a few hours a week, you can still have a solo 401k. And with SEPs and simples, you can also exclude people who have worked for you less than 3 or 2 of the last 5 years, depending on whether it is a SEP or a simple account. So simply that's, and again, another, if you have a lot of turnover and you don't have a lot of people staying with you for a long period of time, you can still have those types of accounts and not have to worry about making those contributions for the employees. But again, what makes the individual 401k plan so appealing? Again, the fact that you could do all these self-directing investments, you get some tax deferred or maybe some tax-free growth. But 401ks simply, they have a higher funding limit. We saw that in the slide about the individual hypothetical with $100,000 of income. The 401k was far and away the ability to put more money into that account in a given year. You have more funding flexibility. You can adjust each year. You can defer all of your, all $18,000 of salary one year and not do anything the next. And very importantly, and this goes back to the Roth slide of when we said there's certain limitations on your adjusted gross income for contributing to a Roth. If you have a solo 401k, there is no income restriction on putting money into that account, whether you are making a Roth contribution or whether you're making just a regular tax-deferred contribution. So again, the huge difference with people who are high earners and you own your own business and your tax advisor says you can't put money into a Roth IRA, you simply make too much. Well, if you qualify for a 401k, not only do you get around that rule that the Roth IRA has, you could put over 3 times as much money into that Roth plan in a given year. With 401ks, you also can borrow. It's a big difference between IRAs and 401ks. With IRAs, you cannot borrow from your own IRA account. If you have a 401k though, whether it's a solo plan or whether you have it through your employer, you usually will have access to borrowing from your 401k and then simply making payments back into that plan. And again, with an individual K, because there are no employees, there is no testing requirement. It's a much cheaper type of account to run. It's more cost effective administratively. So Advanta, what kind of options do we have with a 401k? If you're looking at this, viewing the webinar today and saying, this individual 401k sounds good for me, kind of what are some of the options that we offer at Advanta? Well, first, we have what we would call I call it the full service option. We will provide the 401k plan documents to you, and also we'll perform all of our record keeping functions. So we will receive your contributions, make your investments, keep track of your investments, keep track of the income and expenses generated for that plan. So we not only provide the actual plan document itself, we also are then able to receive your income, pay all the bills on behalf of the 401k plan. The other option we can have, if someone says, I can keep track of my own records, I can keep track of the income, I can keep track of the expenses, I don't mind doing that, we offer a do-your-own plan, where all we do is provide the plan document itself. Now, to have a 401k plan, you can't just simply say, I'm adopting my 401k plan today and just creating a wording for it. You have to have a plan document that is approved by the IRS. Now, you could go to an administrator to get one. You could possibly, I've seen some CPAs draft them in the past, but usually those cost you a couple $1,000 possibly to get your own 401k plan drafted. You can simply lease the 401k plan document for us for a fraction of that initial cost. So we can provide the plan document, you lease the plan from us, and then you're allowed to go get a bank account in the name of your own 401k plan. So you just go down to your local Wells Fargo, your Bank of America, whoever you bank with, open up an account in the name of your 401k, make your contributions directly into that account, and then you, as the trustee of the plan, perform all the record-keeping functions. So no money actually comes into an account with Advanta. It all stays at your own private bank account. With the full service option, you would be sending the money into us, and we would be holding the cash and investing at your direction. So, again, today the genesis is to talk about the differences and similarities between the IRA and a 401k, and here's obviously a slide talking about the similarities. Now, both of them offer tax-deferred or tax-free growth, depending on whether it's a traditional type account or whether a Roth. Both of them have that same tax-deferred or tax-free features. You both have to, for both accounts, you have to have earned income. Okay, you cannot, if you have just all passive investment income, that doesn't qualify for a contribution to a retirement plan, whether it's an IRA or a 401k. They also are subject to the same investment restrictions. Again, you can't buy life insurance and you can't buy collectibles inside of either one of these plans. And you also have to be careful on who you're dealing with. If you're buying property or investing in assets with certain family members, there can be certainly some restrictions there as well. Again, with both of these plans, the income and expenses related to the investments must flow in and out of the account. You can certainly partner up your IRA or your 401k with other individuals to make investments, and we see a lot of that happen in real estate where an IRA or a 401k might partner up with some third party to make an investment, but the profits is there. And certainly the distributions for both an IRA or a 401k, you must be over the age of 59 and a half to take money out of the accounts penalty-free. And again, you may be taxed or not taxed depending on whether it's a traditional or Roth type plan, but there is a penalty for any distributions under the age of 59 and a half. I did have a question just pop up on the webinar, and again, if anyone else is listening, you have something come up, please type your question in. I'll make sure that we get to it. The question said, is this the same? And actually, if you're raising your hand on the screen, I can't unmute everyone to ask the question, so if you can, just do your best to type your question in the chat box, and I'll make sure that we get that answered. But the first question said, is this the same as having the 401k or an IRA owning an LLC or business? And I think he says in regard to the previous slide where I talked about having a bank account. This is different. There's an investment strategy within self-direction where individuals use an IRA to create an LLC. They call it checkbook control, where you then use that LLC to make different investments. You're buying and selling real estate. You're getting a bank account for that LLC. That is different than having a 401k simply go and open up a bank account and have that bank account owned by the 401k. That's one advantage that the 401k has to some extent over the IRA, is that you can simply have that bank account, have that checkbook authority without having to set up an LLC. So that's just, hopefully that answered your question. Having the 401k is a little bit different, or it's different than having the IRA simply owning an LLC with a checkbook control. Another question just came up. Again, please keep them coming. Said, where does passive income go if only earned income can go into a solo K? That's a question more for a tax advisor. There's different ways with passive income to defer taxes with 1031 exchanges and other types of investments and strategies. But in order to contribute to an IRA to a 401k, you have to have earned income, at least to make the contributions. But if you have other passive income and you're looking to protect that from a tax perspective, there certainly are other ways to do it, just not within a self-directed IRA world. So talk with your tax advisor, talk with 1031 exchange experts. They can certainly hopefully pass you along and help you find out what you can do with the passive income. A question said, well, going back to the 401k or IRA LLC question, said, with the approach, would you need the same documentation you mentioned previously? If you were doing a solo 401k, you simply lease our plan document, get a tax ID number from the IRS, and you can simply then just open up your bank account. Now, as far as making investments, I think you still want to document all of your income and your expenses, keeping track of your investments with a solo 401k. But you would not need to have an LLC. You would not need to have an operating agreement set up as well. Because with an IRA, to get that type of checkbook control, you must have to have it. For an IRA to have that control, you have to have an LLC and other documentation required. Question again, kind of good. They're all coming in here rapidly, which is good. It says, is there an advantage to having an LLC with checkbook control versus opening the account directly in the name of the 401k? So you have the option, open the 401k account, open a bank account, and purchase all your investments in the name of the 401k, or simply use the 401k to do the LLC with checkbook control. Again, with an IRA account, you would have to have an LLC to get that degree of control. So that's kind of the advantage of having, if you had an IRA, to do that. Now, again, to have a solo 401k plan, you do have to own your own business. This isn't just, you can just create a 401k plan without a business or a sponsorship for it. But the advantage, I think, to having an LLC can be a legal one. And then again, I can't go too far down that path, but sometimes having investments held in LLCs might protect you more from a liability standpoint. I think if you were simply looking at ease of administration, if you had a 401k plan, I don't see a reason why you would create an LLC, to be honest. I think if you have your own solo K and the liability protection is not your concern, there's no reason to have an LLC with checkbook control, in my opinion. So I hope that answered your question on that. Again, if you have an IRA cannot simply go open up its own bank account in the name of the IRA. That's one of the huge differences between the IRA and the 401k that we'll get to in the next few slides. Another question, can you purchase real estate within a 401k as you can an IRA? You certainly can. And we're going to have a case study here at the end of the webinar today that shows a little bit of the differences. It's a lot, the investment restrictions are the same on what you can and can't do. So you can certainly buy real estate with a 401k. It's just a little bit different process, and we'll talk about that as we go along. Again, great questions. Keep them coming. If you have any more, just please type them in. I'll kind of keep moving along here. So we talked about the similarities between the IRA and the 401k, but what are some of the key differences? Illustrated here in the blue is the IRA. The red is the individual, the solo 401k. Now with an IRA, you must have an approved IRS custodian holding your account, whether that's Advanta, whether that's a Charles Schwab. Your IRA has to be held through that company. That company then has to administer the assets, whether they're buying real estate or buying stocks or investing through an LLC for you. The IRA still has to be maintained with that custodian. But with the 401k, what we talked about with the do your own option, you can be your own trustee and do your own record keeping. The rules allow for that. Now, you might want to get some advice from a tax advisor or CPA to help you along as you do it, but you do not have the requirement that you have to use another company in order to do that. I mentioned earlier that you cannot borrow from your IRA account, but you can take personal loans from a 401k. Now, there's limits. With a 401k, you could borrow $50,000 or 50% of the account value, whichever is less. So the maximum you could borrow would be $50,000, But if you were looking, say, at buying a new automobile, or you just need some cash for an improvement, you could take a loan simply from your 401k. You have to pay it back within 5 years. But when you think about it, ultimately, the interest you're paying on that loan is going right back into your own 401k accounts. You're paying yourself for this loan and increasing the value of your 401k at the same time. With an IRA, if you were to buy real estate and use the leveraging and obtain a mortgage to purchase a piece of real estate, which is a whole nother webinar and topic we could talk about, in general, your IRA is actually subject to a tax at that point. It's one of the rare instances in which an IRA can be subject to unrelated business income tax or unrelated debt finance income tax. That's with an IRA buying a property and using a mortgage to help on the purchase. So an IRA can be subject to some tax based on its income. With a 401k, in the exact same scenario, your 401k making a down payment of 30% and obtaining a non-recourse loan to buy a piece of real estate, the 401k is not going to have to pay that tax. It's a huge difference if you are out there considering buying real estate and not paying all cash, which is what we see a lot of clients do, but you're looking at financing. With the 401k, if you have the ability, you will not have to worry about the UBIT or the UDFI tax. We talked already as well about the ability to make a contribution to a Roth IRA is limited by your adjusted gross income for the year. Again, if you make, quote, too much money, you can't contribute to a Roth. But with the 401k, you own your own business, you set up the 401k, regardless of what your income is, you can make a contribution as a Roth salary deferral into that 401k plan. Now with an IRA, you can contribute to a traditional IRA regardless of your involvement in other 401ks. If you worked for an employer, your employer has a 401k plan that you are participating in, you can still on the side make an additional contribution to your traditional IRA. Now talk with your tax advisor. It's not always a deductible contribution, but you can certainly make the contribution to those IRAs if you wish. If you have you'll say you work from an employer and you have a 401k plan through that employer, but you also have a side business and you want to set up an individual K for your side business, which is allowed, but the contributions that you want to make to your individual K for your side business would be reduced by any contributions that are made to your other employer plan that you have through your main employer. So those, the IRS, it's not, I can't defer $18,000 of my salary at my day job and then also defer $18,000 of salary from my side job into a 401k. The limitations, they aggregate those two types of accounts to come up with your maximum. Now with an IRA, you never have to make additional contributions to the account. So a lot of people, again, have an old 401k, they roll it over into an IRA. They never actually make a contribution out of their pocket into the IRA. It's just a rollover from an existing plan. Or maybe you started an IRA 1 year, you made a contribution, that's all you've ever done, and you've been able to grow that money. You're not required to make any more additional contributions. It doesn't raise any red flags that you're not contributing to an IRA. However, if you were looking at starting an individual 401k plan, the IRS does expect that with these types of plans that you're going to make some type of contributions, whether it's salary deferral, whether it's a profit sharing match at some point during the 401k. If you were setting up the 401k simply as a shell to move your money, to have different control, and never make any contributions from your business into the 401k plan, you could invite some scrutiny from the IRS on is this really a legitimate 401k? Were you setting this up for legitimate 401k reasons? Now, I don't think you have to make contributions every year. And we all remember back in 2008, 2009 when the market was tanking and businesses weren't doing so well, a lot of companies cut off their contributions to 401k plans and suspended them. It didn't violate the plan. There were certain circumstances. So you can, it's not a matter you have to make that every year with a 401k, but the IRS does expect some type of contributions at some point into the plan. Now we've talked about this already with some of the great questions we've had. With an IRA, in order to get checkbook control where you can simply write checks for investments, whether you're paying a bill, whether you're buying a piece of property, with an IRA, you would be required to set up either an LLC, a limited liability company, or a trust to get that type of control. So your IRA becomes the member and the owner of the LLC. Just the difference is the way the rules work. Again, you have to have an IRA custodian holding the IRA. and directing them to put that money into an LLC. So you would still have IRA administrator fees on that side, and you'd have to have an LLC or trust document set up for that checkbook control. But again, the contrast to what we've been talking about with a couple of questions and in the slides is that if you do have a 401k and set up an individual K, it is possible to simply go get a checking account at a local bank set up in the name of the 401k plan. So you don't have to pay for an LLC to be created. You don't have to pay annual filing fees for the LLC. You simply can use a bank account in the name of the 401k and do all your investments in and out of that plan in the name of the 401k plan. Last difference we'll talk about today, with an IRA, if you are engaged in a prohibited transaction, so your IRA buys life insurance or collectible, which is not allowed, or if your IRA were to deal with somebody who's disqualified, you lent money to yourself or you lent money to a family member and things that were not allowed, which we can again go over in other seminars. With an IRA, a prohibited transaction results in a loss of the tax status for your IRA and possible penalties. So if I engage in a prohibited transaction with my IRA ceases to be an IRA the year that activity took place and is fully distributable to me at that time. So I have to pay taxes on it. Depending on my age, I might have a 10% early withdrawal penalty, and on top of that, there's a penalty for being involved in a prohibited transaction in the first place. And the IRS can assess fines and penalties against you for not reporting the prohibited transaction. So if they don't catch what you were doing until 2 or 3 years after the fact, they can go back for 2 or 3 years and assess fines and penalties against the account. And in total, the possibility exists that they could seize your entire IRA account. With a 401k, the prohibited transaction, if your 401k is involved in a prohibited transaction, there is simply a 15% penalty. That's the starter. And again, it's not that a 15% penalty is a good thing. You certainly wouldn't want to have this at all, but the penalties are simply less severe. So that's one of the differences, again, between a 401k and why there are a lot of promoters out there promoting the 401k in case you ever have something ruled to be prohibited, the penalties would be less severe. Now, I think that certainly is a valid reason. But again, to have a 401k plan, you do need to have your own business. It's not a matter of simply saying, I'm just going to create my own 401k plan, but I work for another employer. I don't have a side business. You're not going to qualify to have a 401k plan in the first place. So be aware of some of the promoters out there saying, go get yourself an individual K. There are some other hoops that you need to make sure you can jump through. So question we would get a lot of times, and when I teach classes, I teach seminars, people say, I talked to my financial advisor about buying real estate and buying these alternatives in my IRA, and they said, well, if I was going to do that, I'm going to have a lot of tax implications, and so I'm going to have to pay all these taxes. Financial advisors are either just unaware of how the process works for moving money and exactly what you're looking at trying to do, because when you move money from one retirement account to another, from an IRA to, say, another IRA, that's done by a trustee-to-trustee transfer. It's a non-taxable, non-reportable event to move money from one IRA account to another. So if you have an account at Schwab, you can move the account, those funds to Fidelity, to E-Trade, to Advanta. Doesn't matter. You're not going to pay any taxes moving the money between those accounts. And you can certainly do partial transfers. You do not have to move all of the money from one account to the other. And in fact, many of our clients maintain multiple IRA accounts at different firms and move money between them via transfer. If you're moving money from an employer-sponsored plan, is simply just a different term. It's called a direct rollover to move money from an old 401k, 403b plans, etc., into an IRA. Now, again, because the client and the 401k owner doesn't touch the money, it is a non-taxable event. So again, when you're transferring or doing a direct rollover, the money never touches your hands. It's not taxable to you. And you can do transfers and direct rollovers within an IRA or 401k as often as you would like. There is no limitation. There's no taxes due, and especially when you're talking about what your IRA is going to be invested in, the earnings that you're going to grow inside your account are going to ultimately be tax-free and unlimited as well. Okay, so when you're buying property and you get rental income, investing in a stock and getting a dividend, the income and the earnings are unlimited. The limitations only applied to these plans are the contribution limits we talked about earlier. So the possible investments we went over, again, whether it's an IRA or a 401k, include any type of real estate, the paper assets of mortgage loans, unsecured notes, tax liens, and then the private partnerships, the private LLCs, private foreign currency trading accounts. Again, there's just a lot of things. As long as you're not investing in life insurance, You're not investing in collectibles. Your IRA can make an investment. Now, when you're dealing with real estate and lending and some of those deals, you also have to be careful of who you're dealing with. There are certain disqualified persons that we would be happy to let you know who those individuals are. But if you're dealing with third parties, people unrelated to you, you really have just an unlimited amount of investments that you can make and different ways you can structure deals. So we'll go through a case study now. Just one case study, again, illustrates some of the differences between an IRA buying real estate and a 401k, and what's involved and how that process changes a little bit. So we're just going to start off with John. Has $130,000 in retirement funds, whether it's an IRA or a 401k. We'll go over those differences in a minute. But wants to invest in real estate. Figures he can find a property. He's got $130,000. He can find a property for $100,000. Get another $8,000 or $10,000 of work into the property. Get it ready to rent. But he figures after he gets that property repaired, he'll net rent $1,500 a month back into his retirement plan. So how would John go about doing this particular investment? The first step for John would be to open up and fund his Advanta account. So filling out the paperwork, whether it's the paperwork to establish an IRA, whether it's the paperwork to establish a solo 401k, that's the first step. Contacting us, getting our forms, getting that filled out, takes 15-20 minutes to get those documents filled out and started. And then he would fund his account by either transferring or rolling over from his other IRA or 401k plan administrator. And again, we would advise John at that point how to do that, what the process is, getting the right paperwork, and helping get started. So he's going to open up and fund his account. Once he's done that, he can find his investment property, go out there, work with a local realtor, work with other investors, locate his investment, and make an offer to purchase. It's going to be up to John, as it's a self-directed account, to decide what he wants to buy, how much he wants to buy it for. But once he's settled on a property, he would submit a form to us at Advanta called a purchase authorization form, saying, I found 123 Main Street. I'm going to buy it at $100,000. The title company or the attorney handling the closing is so-and-so. Our job at Advanta will be to make sure then that the title company or the attorney drafts the closing documents correctly in the name of either the IRA or the 401k plan. And we'll go over that titling here in just a moment. If we are doing the administration at Advanta for the account and doing all the record keeping, we will make sure John reviews and approves all documents prior to closing before we send any money out of the account. But we will also make sure the documents get properly worded as well. If John was buying this property with an IRA, a self-directed traditional or self-directed Roth IRA, ultimately a representative from Advanta will sign the closing documents on behalf of his IRA account. So whether it's our manager or one of our other authorized signers, we would actually sign the contract, sign the HUD statement, sign any other closing documents on behalf of the IRA. If John instead was using a 401k plan, so he's got a solo 401k plan, he is the trustee of that plan, and John would then sign all of those closing documents on behalf of the 401k plan in his capacity as trustee. We would still want to make sure everything was properly titled, make sure John has approved the documents for us, and then we would send the funds out. John will execute the documents at closing. So if he's buying the property, just the things to remember. Now, the buyer's name on the documents are going to be different depending on the type of an account. Regardless of which type of account, the documents have to reflect the retirement plan is the owner, or the buyer in this case, of the real estate. Now, if John was buying this through an IRA account, the name on the documents would read Advanta IRA, our company name, for the benefit of, or FBO, John Smith's IRA and his account number. So that would need to be on the contract and then ultimately on all the closing documents as well. That's the legal wording for his IRA. If John was using a 401k plan, he would title the buyer's name as John Smith, trustee of the ABC 401k plan for benefit of John Smith as participant. So whatever his 401k plan, I would say inserted ABC, but it'd be John Smith as trustee of the name of his 401k plan for the benefit of then him as participant. And that would be the buyer's name. And again, we would work with John to make sure that that proper wording is reflected as there. And again, that has to be on the contract, the HUD, the deed, any closing documents reflects that the retirement plan, whether it's an IRA or 401k, is the owner. If there are other partners involved, John is using his IRA or 401k to team up with other people, then the percentage that the IRA will own also needs to be indicated on those documents as well. So after this deal closes, how are the income and expenses handled? If John is having his IRA or 401k plan and the cash held by us and having kind of going with our full service option on the 401k or simply having an IRA, then John will submit his bills directly to us, and we will cut a check out of his IRA or out of his 401k to pay those bills, usually within 1 to 2 business days at the most. So all expenses related to this property have to be paid either from the IRA or from the 401k plan that owns it. And again, if we are holding the assets and we are holding the cash and doing the administration, John sends the bill to us, we cut a check out of his account to pay that bill. If John was doing a 401k and chose to do the do-your-own model, again, if we remember, he is going to have a checking account at a local bank in the name of his 401k plan. He can simply check and pay this bill directly out of that particular account. So he'll simply write a check out of that checking account from the purchase in the name of the 401k. As far as income goes, again, if Advanta is holding the income and we're holding the cash and holding investment, the income that is derived from the property, the rental income, will be sent back into the IRA or back into the 401k, and we will receive and deposit that into his account. John could maybe collect the checks, from his tenant and make sure they just ultimately they'll forward it and deposit it back into the 401k or in the IRA with us at Advanta. And John can track his account online through automatic email notifications to see this money coming into his account and also show the expenses going out. So the IRA or 401k plan, and we're holding that at Advanta, the tenant's going to make the check out to the IRA to the 401k. We'll deposit, and John tracks his money online. In contrasting that with the do-your-own model, John has that checking account at a bank. He can have the tenant make the check out to his 401k plan. He can simply deposit that into the bank account that he has set up for that 401k plan. But again, when you overarching principle, if your IRA owns a piece of real estate in this instance, or a 401k owns the real estate, all of the income that's generated flows back into the retirement plan. Nothing goes to John personally. So if you didn't have enough money, what kind of options would he have? One, we kind of have touched on it a little bit on the periphery. If you have money in your IRA or in your 401k that's not enough, you could certainly partner up with other people, whether it's your spouse, whether it's your personal money, whether it's other people's money, their IRAs. You just have to split the income and expenses proportionally between your retirement plan and your partner, again, whether that's somebody else's IRA or somebody else's personal funds. If you're short, you can make an annual contribution, and especially when you see it with a 401k, you can contribute up to $53,000 a year if you have a solo K. You might have the ability with that type of plan to really bridge the gap between what you have and what you need in order to make an investment. Lastly, it is permissible for an IRA or a 401k to borrow money. It just has to be in the form of a non-recourse loan. And a non-recourse loan is one in which the IRA or the 401k borrows money from a bank. The bank lends that money directly to the IRA or the 401k, and that retirement plan then makes the loan payment. With a non-recourse loan, there is no personal guarantee on that particular loan. That's what a non-recourse loan is. The bank or the lender has no recourse against the individual for the actual repayment of the loan. We mentioned earlier, if you do this through an IRA account and your IRA borrows money of the non-recourse loan and buys a property, you will subject the IRA to unrelated debt-financed income tax. Doesn't make it prohibited, just makes you need to do an additional calculation to make sure this is going to make sense for you and your IRA. But again, with a 401k, UDFI and UBIT tax does not apply. So if you're looking at leveraging and you own your own business and looking at leveraging within your retirement account, a 401k plan can be absolutely fantastic because you're not going to have that implication of that particular UBIT tax. Question came up when we talked about non-recourse loans. Can a non-recourse loan be from a private lender, not a bank? Certainly. The only requirements is that the loan documents state, whether it's an individual lending to your IRA or 401k, or whether it's a bank, that the language state on there that this is a non-recourse loan, and that if you have to sign, you're not signing personally guaranteeing that particular loan. Question, with a 401k, does there have to be a separate 401k LLC established, Or is it okay to have the Advanta 401k account only? It is okay to have the 401k account only at a local bank, but I have also seen people set up a 401k, an LLC for their 401k as well for legal purposes, whether it's for liability protection or whether because they're actually having their 401k plan mesh with other individuals in a partnership. You can certainly do either. It's just not required. It's not mandatory that you have an LLC, but I certainly have seen a lot of people use it. That's more of a personal decision, one hopefully an attorney can give you some more advice there as well. So it is okay to have the account only and just simply make the investments that way. Certainly other people have worked to set up an LLC as well. It's really, again, a personal choice, and I'd be happy to talk with you more about that as well going forward. Well, we're about at the end of our time. I just want to reiterate, thank everybody for attending. Just remember, it's very easy to get started. Opening up an account, funding your account with a transfer or rollover, and then ultimately choose the investment and making the investment, having us help you either with the record keeping, and we're actually receiving the rents, paying the bills, or in this case, if you're looking just to rent your plan, you can simply do that on your own. And somebody asked a question, so when you rent the docs from Advanta, you are covered. Well, in a sense, if you rent the documents from us, you are covered in that you do have a 401k plan that you're based off. So the IRS says we need to see your 401k plan document. We have that, and we've already provided that to you. You're covered. You're doing a legitimate 401k plan. But when you're doing your own record keeping, you need to make sure that you're properly reporting things to the IRS, make sure that you're not commingling your personal money. So depending on your expertise in that area, you're covered in the sense that you have a valid 401k plan and you're existing legally. You just have to make sure you're operating that correctly as well. Question says, are there fees for the full service versus do your own? Yeah, the difference is we charge for a 401k plan that's different from an IRA is we have a $300 a year fee to lease our 401k plan document. So if you're doing your own, that's the only fee you're going to have is just a $300 a year basically fee to lease our plan. If you're doing the full service option, you have the $300 to lease our plan, and we do charge, in rough terms, $295 a year per asset to record keep your assets as well. And we have other costs, some smaller costs when you're buying assets and going through transactions. So the full service is our standard IRA fees of $295 a year for each asset to receive and deposit rents and pay bills and keep track of your account. But the 401k, the full service, you're going to have an additional $300 a year fee to lease the plan. But again, if you're doing your own plan and you're doing your own record keeping in a local bank, all you have to do is pay that $300 a year fee to us to lease the plan. And then you do your own record keeping, obviously nothing else that you're going to pay us to do. So I want to thank everybody again for coming to the webinar. If you have any additional questions from the seminar, I do want to wrap it up. We're almost here at our time. Please call me. Please shoot me an email. I'll be more than happy to answer your questions or talk with you about your specific concern. You can certainly visit our website at advantaira.com for more upcoming events and seminars. If you live close to one of our offices in either Atlanta or Tampa, we'd be more than happy to have you come in for a one-on-one consultation or come to one of our live seminars. Otherwise, you're certainly welcome to call us. We can do phone conferences and certainly participate in more educational webinars like the one we had today. So please check the website for other upcoming events. If you have any questions at all regarding IRAs or self-direction, just reach out to us. We're always available for free consultations and giving out that free educational advice. So again, thank you everybody for participating this morning. We look forward to talking with you.